Hello. Today I'm joined by Peter Spiller, Fund Manager of the Capital Gearing Investment Trust. So, Peter, capital gearing is a wealth preservation vehicle that has delivered positive returns in all but 1 year under your tenure since 1982. So, what's been the secret to that success?
Well, Kyle, the purpose of this trust has always been to not lose money, number one, but secondly, to do better than the equity markets over time. Now, that should not be possible if you read theory, but I think we have proved that it can be done. And it's all driven by asset allocation. So the principles of our asset allocation are very simple, that when prospective returns in an asset class are high and risk is low, then you want to lock those returns in for as long as possible, as high duration as possible. And the converse obviously is true when returns are looking poor and risk is high, which I have to say largely describes the current situation. But back in '82, when I started, there was a most wonderful opportunity because P's were low, inflation was high but falling, interest rates were high but falling, and the prospective returns in all asset classes actually were terrific. But equities are by far the longest duration asset. So if you want to to lock in those returns, then equities are the way to do it. And back in those days, we had 100% in equities. Just very quickly, fast forward, I won't go through every year, but fast forward to the end of the 90s. By then, equities were looking dreadful value and high risk. But bonds still offered high real yields, 4.5%, that sort of thing. And so we had very few equities and a lot of bonds, and proper duration bonds. So we owned 30-year bonds, for instance, at that time. The truth of the matter is that actually, once you've got a balance of equities and bonds, then you've got a chance at having negative correlating assets. And that's worked particularly well over the last decade and a half with TIPS, who it's one of the most reliable negative correlations in financial markets is TIPS against UK equities. So that has been extremely helpful.
And what is the current exposure to equities, and how does that compare to its level prior to the pandemic?
Actually, I'll do it the other way around if it's all right with you, Carl. So we were very lucky because at the end of 2019, beginning of 2020, a lot of private clients had bid the prices of renewable infrastructure, particularly, to very high levels. So the big premium, and we sold them all. So our total risk asset exposure fell from sort of 45 down to about the low 30s as we went into February 2020, and we simply could not find attractive investments to go into at that stage. So we were very lucky because when March 20 came along, we had a lot of cash, and we bought in March when the market fell. So that was great, added to equities, but more particularly because equities recovered very quickly. You recall, almost V-shaped in their behavior. But what didn't was property, and specialized property offered fantastic opportunities. So a company like Tritax Big Box, for instance, which is in a substantial part a credit portfolio, i.e. long leases to creditworthy companies, and they fell to a huge discount, 50% discount to their assets. So we bought a lot of that sort of thing. So that brought our risk asset exposure right up to close to 50%. Latterly, we've been reducing it a little bit because we feel less confident that the potential returns remain as high as they were, and risk is definitely rising. So currently we have probably about 18% in equities, but a further 26% or so in other kinds of equities. So that a lot of that will be property, again, this specialized property, which we think will be very efficient at dealing with inflation. And a fair whack of infrastructure and renewables, that sort of thing.
So is it infrastructure, renewables, and property is where you're finding the sort of value opportunities at the moment? And I was wondering if you could name a couple of investment trusts that you invest in those areas.
Yeah. Oh well, we tend to invest in they're called investment trusts. That's the structure of them, but then they're not really investment trusts. They're operating companies, aren't they? In all cases. So one that I would pick up, for instance, is Granger. So Granger is the biggest PRS company in the UK, and it's not that we expect vast returns, but we believe that inflation will be problematic in the UK, but that rents over time will at least match inflation. And with the pipeline of developments and gearing, it'll probably produce decent real returns. Nothing exciting, but decent real returns. A solid rock to rest a portfolio on. When it comes to investment trusts, there are still some great bargains out there. So one that I would pick out would be North Atlantic Securities, run by Chris Mills. Fantastic record compared with any investment trust in the UK, but still trades on a 22-23 discount. It's really been an amazing opportunity. We've held it for a very long time, continue to.
And are you finding, in general, there are a few more investment trust discount opportunities at the moment, given there's been a bit of a pickup in market volatility over the past couple of months?
Yes, not like the old days, Carl, I have to say. And I think that the key characteristic of investment trusts actually is that in the short term, you don't tend to get, or if you get short-term dips, you don't tend to get huge opportunities in investment trusts. Maybe they go 1 or 2%, 3% wider, but that's kind of it. And with most investment trusts, there is considerable downside in the discount, because in bear markets, a proper bear market, i.e., one which lasts for more than 6 weeks, then you do get sales of trusts at ever lower prices. I think it's because psychologically people relate the price not to the asset value today, but what they expect it to be in a month's time. And if every day you come in, then the market's lower, then you start to discount those asset values by more. So I think there will be great opportunities, but as a general statement, over the last 15 years, discounts have tightened enormously, and corporate governance is beginning to improve. So we are now seeing more ZDMs like capital gearing, and those should be emphasized. Those ZDMs aren't just a reassurance that we won't go to a large discount, remove the discount threat, but also because they issue on slightly higher asset values than it costs them to invest, or higher premium than it costs them to invest, and ditto in redemptions, they're adding asset value all the time from that process. So capital gearing trust, for instance, essentially has no management fee at all in the last year, because it's all been paid for by the redemption process and issuing process.
The rest of the portfolio is in defensive armory. Could you run through the rationale behind your investments in inflation-linked bonds, which comprise around 30% of the portfolio?
Yes. Well, first of all, I think we're going to cover the prospects for inflation in a different video, but the first thing to say is what I mentioned already, this extraordinary negative correlation, which provides fantastic stability to to portfolios going forward. But secondly, we do believe that inflation will be the big issue that faces investors trying to preserve the real value of their capital. And although we've moved a long way, so we've gone from 4.5% yields to -0.5 in tips at the long end, I still think there is much further to go. And the reason for that, just very quickly, is because of debt. So debt levels are so high that the only way to deal with them without massive defaults, which obviously involves a depression, is to have financial repression. That's to say, inflation rates that are significantly higher, certainly than they have been. They're pretty high just at this particular moment. And interest rates that are well below those rates of inflation. So I expect negative real yields on tips to get much bigger, more negative, which will provide a very significant capital gain. So the UK, the comparative value is extraordinary with the UK. So there's basically 2% difference in yield. The UK 2% more expensive.
Peter, thank you for your time today.
Not at all.